Welcome back to the PRI Digital Forum Americas. President-elect Joe Biden's ambitious climate plan could put the U.S. on a track towards meeting the Paris Agreement goals and will likely catalyze policy shifts to many other countries as well. To tell us more about the investor role in all of this, we're going to be joined now by a fantastic panel. Don't forget you can ask questions via the Q&A tab and post on social media using hashtag PRI Digital Forum. I'll hand over now to the PRI's Director of Climate Change, also the COP26 High-Level Champions Finance Lead, Sagarika Chatterjee.
Thank you, Lindsay. Welcome to this session on the inevitable policy response. I'm really delighted to introduce our speakers today. We have with us Kate Gordon from the Office of California Governor Gavin Newsom, Jason Ice, Executive Director of Vivid Economics, Mary Catherine Leder, Head of Aladdin Sustainability at BlackRock, and Bertrand, Head of Climate Risk and Issues at CDPQ. So why this session? So as Lindsay outlined, we believe that the stage is set for an inevitable policy response, which we think will be forceful and disruptive. So before we turn to our speakers and go deeper into this with some a presentation by Jason, I want to introduce 4 key things to have on your radar for this year. The first is the Paris Agreement and COP26 in November 2021, 1 year from now. And we're anticipating that the US will rejoin the Paris Agreement after January 2021. And we're also anticipating that high emitting countries will start to really raise their ambition towards net zero. The EU is expected to do so in December 2020. China's made a net zero announcement. Let's see how that's implemented. And as part of COP26, a global campaign has been launched by the organizers of COP26, the Race to Zero campaign. We really welcome our America's PRI signatories joining the Race to Zero. As Lindsay mentioned, I'm on part-time secondment to COP26, so please do reach out if you'd like to get involved in the Race to Zero. The second thing I want to put on your radar is that portfolio alignment with net zero is really starting to take off. So PRI with UnipFi recently, about 1 year ago now, launched the Net Zero Asset Owner Alliance, which is a leadership group of 30 asset owners. And that group has published a new target setting methodology. 3 new members are joining this week, and they've also published a coal position. So keep an eye out for how that one takes off and the impact it has in the broader investment industry. The third thing I want to put on your radar is how much Tcfd is advancing. So we just published this week the new PRI 2021 reporting framework. And as you may have seen, that will include requiring signatories to publish how they're looking at governance and strategy based on Tcfd indicators. On a session after this, we're going to hear from Banco de Mexico about the NGFS, the new network that's been launched some time ago now has 60 members of central bankers and supervisors. And we're delighted to hear that the Fed may be joining the NGFS. Finally, the inevitable policy response. So we see this as gathering pace, and we've published a recent new report on negative emissions technology. Today, a new piece on the election, focusing on Biden's climate plan that we'll talk about in a moment. And we've also published a US climate policy briefing earlier this year. So this session is going to look at the inevitable policy response and climate risk from firstly a policymaker perspective, secondly an analytical perspective, thirdly an investment manager, and finally an asset owner perspective. So I'm going to turn now to Kate. Kate, if we just take a step back and think about California, looking forwards, what opportunities do you see climate change presents Californians and also the US today?
Thanks so much. I hope you can hear me. I shouldn't be muted. You can hear me, I'm assuming? Perfect, thank you. So thank you, first of all, so much for the invitation and to work with PRI, who I have huge respect for. This issue around climate risk mitigation, climate opportunity is so important to us in California. You know, California has extremely strong climate goals. I think everyone knows this. We are the 5th largest economy in the world. We pride ourselves on being a leader on climate. In particular, we have committed through first Governor Brown and now my governor, Governor Gavin Newsom, to achieving carbon neutrality by 2045. The question is, how do we get there and how do we prioritize? That's a big ask. Governor Newsom's approach on climate, and I think it's very consistent with President-elect Biden's approach, is really an integrated approach across all sectors and regions of our state, including carbon mitigation, climate resilience, and carbon removal. So we're looking across all three to get to that carbon neutrality goal. In particular, we're focusing on a few key areas given our emissions picture and our climate impacts. One is transportation. In California, 51% of our emissions are from transportation if you count our oil and gas extraction and refining sector along with our tailpipe emissions. So that's a big priority, which also includes reducing vehicle miles traveled, a very tough nut to crack, but a really important one for us. The second big key area for us is natural and working lands and their contribution to carbon removal and to climate resilience. Just as an example on California, it's sort of amazing to many people, it was to me, California's entire 40 million population lives on about 6% of our land mass. 45% of our land is federally owned, 25% is dedicated to agriculture. We have a lot of natural and working land in the state of California. How do we make sure that's part of the picture? And then finally, and very relevant to this conversation, climate finance work, including risk reduction and leveraging private capital. So I want to talk a little bit more about the finance side, since it's so relevant to this audience and to the other speakers. The first week after the election, when Governor Newsom was elected, the first week of his time as governor-elect, the Camp Fire happened, which was the major fire in California in 2018 that was at the time the largest fire we'd ever had. 85 people were killed by that fire, a huge amount of acreage burned. Governor Newsom's first week on his job, we saw our largest utility, Pacific Gas and Electric, declare bankruptcy, and all three ratings agencies downgrade all of our utilities. So the intersection of climate risk, physical climate impacts, and our budget and the economy is very, very top of mind in California. And as folks probably know, we now have had the next two largest fire years in California's history. This year, over 4 million acres burned. So it's a very top of mind issue for us. In September of last year, the governor put out an executive order that really recognized that California is itself a major asset owner and investor. We have a transportation system that's enormous. We have 19 million square feet of buildings. We have 51,000 fleet vehicles. We're very big. So the governor said our largest asset owning agencies, transportation and our Department of General Services, our government services basically, need to align their priorities with our climate goals on both mitigation and on climate risk reduction. We cannot be investing in roads that will then be underwater, that will then be on fire, that will then be melt because of extreme heat. He also asked us to work, our Department of Finance, to work directly with our pension system. Our two largest funds together have about $700 billion dollars in investments to develop a climate investment framework that also aligns with our climate goals as a state. So all of that happened. And so coming back this year, a couple of things were added to that picture. One is that in January of this year, the governor put into place a infrastructure bank, essentially fund for climate change, essentially a green bank or a climate bank, called the Climate Catalyst Fund, to really focus on leveraging private investment into some of the impact projects and really kind of frontline projects on getting us to that carbon neutrality goal. The other thing, though, is that we actually released our climate investment framework. And what that does is calls for more of our pension money to be invested and directed to zero carbon indexes. We can't direct our pension funds, to be clear, legally. They're independent, but we are sort of saying, encourage you to direct more funds to zero carbon index. We've also been directed to create a work group on climate risk disclosure. The governor is very serious about California taking an active leadership role on identifying how the state can play a role with mandatory disclosure. We've also joined the International Coalition on Climate Resilient Investment. So we're really looking at, again, California as an investor, California as an asset owner, leading and learning from the best in class in the private sector on these issues. The last thing I'll say on this is that I think, and important to the conversation, that work group, which my agency, the Office of Planning and Research, is tasked with putting together. We are putting the work group together with both public and private sector experts. We will use the Tcfd framework. We're very convinced, I think, that that's where people are going, that framework is getting adopted in many places. We will be looking at both transition risk and physical risk, and I think that's important. On the transition risk side, in some ways, that's easier in California than in many places. We have a very clear policy framework on carbon emission reduction through our cap and trade program, our low carbon fuel system, our 100% clean electricity by 2045 goal. We have very clear policies to plan for. You can't really do business in California without thinking about those policies. We do need a better understanding of how companies say they're planning for the economic transition to carbon neutrality, especially since we're an oil and gas producing state. So how do we start thinking about that side of transition risk? My office, I should say, is leading on our just transition strategies as well. We see these as part and parcel of the same conversation. On the physical risk side, that gets less attention from the international investment community. And I just want to really highlight it because in California, it's our highest priority. We are spending $1 billion this year on firefighting in the state of California. That is $650 million over budget, over what we planned for. That's just personnel and vehicles. That is not even resilience or recovery. So we are fiscally responsible for emergency response and all the safety net programs that support the vulnerable communities that are most affected by climate disasters. I will just say, if we don't get ahead of this, it's a moral issue, it's a safety issue, but frankly, if we and other states and countries don't get ahead of this, it will be our entire budget. Our entire budgets will be emergency response and safety net programs, and that will take away any opportunity we have to spend on innovation, to spend on incentives, to spend on the sort of the opportunity side of this equation. So cannot put too fine a point on that. It's incredibly important to us. And I think we are the leading edge, unfortunately, on this issue. And I think a lot of others will start seeing the same thing. So I'll end by just saying, mitigating climate risk is a key part of our priorities. We don't think we can seize opportunities without doing that. And we are really looking forward to the conversation.
Thank you, Kate. And I think that budget number really sends a shiver down my spine in terms of the future implications. I want to ask you just one quick follow-up. So
Sure,
we're in the early days of thinking about, the US election results, but I don't, kind of what's your gut instinct around what this now enables you to do in California, in terms of your role, what, the governor would really love to see happening?
Yeah, it's a great question. I mean, the single biggest thing it does is gives us hope for a stimulus package. We need, again, these things are all related. We need to have a federal stimulus package to help us fight COVID, deal with some of the unemployment numbers we're seeing, deal with some of the other safety net issues, or else that will be our whole budget, right? So we can't spend on climate if we are taking over our budget with those issues. We're not able to do deficit spending in California. We have a constitutional requirement not to. So we have to balance the budget. So the stimulus is critical. We really think there's an opportunity for the stimulus to have, and this is how we look at it in California, to overlay that with core criteria around climate and equity. We really see an opportunity to have stimulus dollars aligned under our Biden administration toward sustainability, toward resilience, toward inclusive economic growth, which are our values in California as well. So we see a lot of opportunity for alignment with the work California's been doing for a very long time. Further down, the legislative question is still an open question in terms of the composition of Congress, but I do see bipartisan opportunities around a clean energy standard that would not preempt high standards like California's, but would allow us to work more closely with other states on things like regional grid networks and other things that are really critical to us reaching our goals. So we see a lot of opportunity. We're really excited to work with the administration.
Thank you. That's really helpful, Kate. Jason, I'm going to turn to you now. And just a quick reminder to our audience that the Inevitable Policy Response was commissioned by PRI. Vivid Economics is a key partner alongside Energy Transition Advisors. Jason, could you just give us initially, I think, a bit of a refresh and recap of what is the Inevitable Policy Response, and then take us a little bit deeper into the opportunity side and also how you see this playing out under what we know of Biden's climate plan?
Sagarica. So I think Kate set the stage very well. The inevitable policy response, as commissioned by PRI, is essentially an attempt to help better inform investors about the types of policies that Kate described right now in California, but really globally, and to fill a gap that I think was identified by PRI and its members in terms of really the depth to which investors have a forward-looking view of what these policies are likely to be and how they're likely to affect the economy, which sectors are most at risk, and ultimately, what it'll mean to asset values and variation across asset classes and the types of risks and opportunities that investors face. So the core of the work was really laying out this realistic, credible, high conviction view of how we see the inevitable policy response unfolding. And in contrast to what people might know about scenarios, it was making a strong case that such a response is coming and why it's coming and what it'll look like. So from the get-go, a large emphasis on why a set of factors are driving a shift in the market. And there's many factors. We've heard from Kate a lot about the actual impacts of weather and climate risks impacting public opinion and public policy. We've seen significant policy leadership lately through things like the Paris Accord, and of course we know that there's action taking place at the corporate and investor level, seeing changes in technology and seeing some of the market opportunities. So there's a number of factors that we can see are shifting the market, and taken together make a powerful case for why we think over the next few years there'll be a much clearer and fairly abrupt shift in the way policy is driving the market. This kind of one figure gives a bit of a sense of what we were trying to do with the IPR, and essentially, in contrast to what maybe a lot of investors know of in terms of hypothetical scenarios for a future transition, the aim was to create real market intelligence in terms of what's happening in the near term, how likely and quickly will a ratchet take place, and what does it mean? And a lot of it is really around the next 10 years and sort of our kind of bottom-up view about how a fairly sudden shift will take place with steadily ratcheting up climate commitments. So I don't have much time, so I'm just going to give a kind of a quick view of what the kind of the policy forecast came out with, and then talk quickly about the U.S. election and what it means. But in broad terms, the impact of this sort of policy response, kind of country by country and sector by sector, is large, and it's large across a number of critical sectors. So of course it includes rapid changes in the energy system, changes in fossil fuel demand, and of course the inverse of large build out of alternative energy sources. It's deeply transformative in the transportation sector, with a series of quite stringent bans on ICE vehicles and a shift towards alternative zero carbon, especially electric vehicles, with large knock-on effects for things like oil and gas markets. And finally, it actually affects a broader set of sectors that we often don't think about, but which Kate actually right now highlighted quite well, which is around land use and agriculture. Shifts in the way land is used, the way it's priced, and a whole set of new markets that might emerge from it. I'll walk through some of these implications in more detail, and of course I encourage people to look at the much more thorough documentation online. But I think the idea is that if we trace policy changes across countries and across sectors in a lot of detail, you build a really convincing case of quite a sudden shift in economic activity. And as you'd expect, this will affect markets. I'm going to focus today on equity markets, although we've looked across bond and both corporate and sovereign bond markets. But in broad terms, it's not necessarily about a large overall market shift. In some ways, the shifts to the overall market are probably quite manageable. But it is about a real disruption in specific sectors and specific companies. It will affect regions differently, depending on the nature of their current activities. And it's likely to create a different set of factors that might drive differentiation across asset classes. And I'll jump into a few of those points in the coming slides. So first and foremost, I think it's really critical to understand how this shift is both very large, very different across sectors, as you can see in this chart, which shows how impacts on average affect sectors and how impacts affect within sectors. We see certain sectors that are clearly kind of winners or losers, especially in the traditional energy sector, like fossil fuels, and in many of the utilities today. But even more importantly, we see quite a lot of within sector variation. Many companies providing alternative services in the same sector could be quite large winners in a net zero transition or a sudden policy response transition. And it's not necessarily only about sectors overall winning. It's actually more importantly about companies that are shifting from, I guess, higher carbon forms of goods and services to lower carbon. And that's an important insight that kind of filters through the entire exercise. So as we see this inevitable policy response unfolding, what we're actually seeing is a real bifurcation in the market. We just saw it in the previous slide in equities, but it actually plays out in other asset classes, especially infrastructure, but also to some extent real estate and private equity, where what we're seeing is essentially a carbon factor of sorts. There's been a lot of recent work about a carbon as an asset class, about differentiations and kind of risk ratios depending on your how a specific asset will stack up under a transition like the IPR transition. And I think the work we've done has really underlined how strong that case is. That so much of the way we look at asset classes today, so much of the way we think about risks and risk premium has to be done through a lens of kind of high carbon versus low carbon or zero carbon, and the possible differentiation in returns, the variation across asset classes is enormous. So the other side of it, which I think is an important point to emphasize, is that this transition is also about completely new asset classes and new sectors, and in particular, I wanted to quickly emphasize land use, where we're seeing a whole set of transitions that most investors don't really appreciate. Part of it's about changes in risks to traditional sectors, either upstream, midstream, or downstream food and beverage sectors, and risks related to market access, risk related to legal liabilities, and those risks have much larger implications potentially on companies than I think investors have appreciated. With so much emphasis, say, on oil and gas and the fossil fuels, quite a lot of the risks in the agricultural sector have been kind of underplayed. And at the same time, the reverse of this, and harkening back to Kate's point about the land in agriculture, the land in California, there's an emerging set of asset classes, particularly related to kind of carbon sequestration and natural climate solutions that have very large growth potential. So we're seeing a shift, California being a leading example of countries and states making new markets available, markets that allow you to gain the carbon benefits from changes in land use. And the size of that kind of opportunity is actually so large, it could become an asset class whose value is as big as the oil and gas sector today. So it's really shifting from one sort of traditional set of assets and values to a totally new one. So that's a run through of kind of the overall lessons learned. Importantly, the IPR sort of forward-looking policy forecast was done prior to the U.S. election, and one of the things that we're now doing is preparing for a refresh post-election. But I wanted to share just a few thoughts before I wrap up about what we know about the U.S. election and how it affects the view that we put together. So first and foremost, I think it's important to say that the forecast that we developed before the election has actually held up really well in terms of what we've seen lately in the policy space. So besides the US, we've recently seen announcements from China, Japan, South Korea, and even accelerated announcements by the EU in terms of their commitments to decarbonization, all of which actually align quite well with the views that were taken in the forecast earlier in the year. So we think that this thesis of a policy response, and one that's going to push markets quite quickly, is in some ways already coming to fruition. In the case of the United States, I think it's important to recognize that there's a set of forces, and that Biden will be unlocking quite a lot of action on the U.S. side through executive powers, which I'll talk about a little bit more. Of course, through facilitating state and local action, as we heard from the California side, but also by enabling, I think, broader geopolitical engagement that's much more productive and creating positive momentum globally. There are, of course, some limitations, especially if the Senate remains Republican and very divided. This will probably mean it's less ambitious than the full Biden program. There will be potentially limitations on how far stimulus goes versus a plan under which there was a Biden administration supported by Congress, the full support of Congress. But nevertheless, our sort of emerging view and what we've put out today in a paper is that Biden will have a significant influence in moving the U.S. towards the IPR kind of conviction of significant action. We can see that an administration will have quite significant powers to act in terms of setting expectations for significant change. It sets out, I think, a democratic platform that regardless of specific near-term electoral success or failure, shows that a very strong and now quite successful party is going to be coming back to this agenda. It's going to be setting aggressive targets. I think it sends a long-term signal that this is something that's part of the political agenda in the United States. It also, of course, helps unlock a lot of the global diplomacy in a way that has just been frozen by I think the Trump administration and its sort of determination to sideline climate as a key issue. It also allows for a lot of executive action. There's executive action opportunities across various standards and direct regulation, as we know from the Obama administration's actions in this space. There's also direct action possible through government's own procurement. It has a large footprint and is a major buyer of goods and an owner of assets. And we think that there'll be opportunities in terms of its ability to unlock action in specific sectors and regions through planning permissions, easier leasing for renewables, et cetera. And finally, although with some limitations, we think there will be a significant push forward through the stimulus plan. There are a number of common areas across the Republican and the Democratic sides of the aisle that at least a much larger push than would have otherwise been expected will be seen. So with that, let me just wrap up to say that I think we're surprisingly on track, maybe unsurprisingly on track, for the kind of significant shift that the IPR initiative has been laying out for investors, and more to come in the next few months.
Great. Thank you so much, Jason. Now, I want to ask you just one quick follow-up, because I think it was about a month ago, you released a new report that was looking at the growth in corporate net zero commitments and how that's spurring negative emissions technology. And I think you estimated that reforestation and afforestation could generate $800 billion in annual revenues by 2050, with assets valued at well over $1.2 trillion. Could you just briefly tell us a bit about how you see that as the new potential investment frontier before we turn to our investor colleagues?
Yeah, so thanks, Sagarika. I mean, I think Kate put it well with some of her numbers around California. There is a large amount of land whose value in terms of helping mitigate climate change through carbon sequestration and through its broader impact on climate is simply not being utilized. It's an enormous amount of value that's being left on the table, and that once sort of mobilized, we think will rapidly scale up. And so there have been, as you say, a really significant increase in corporate commitments, which are already starting to spark the market. It's bringing us through that early stage of proving out at-scale solutions. And so if you think of your typical S-curve in any sort of new, rapidly developing market, we can see that critical mass, now billions of dollars, and will be billions of dollars a year over the next few years, really moving the market up the curve, developing the technologies, ensuring the MRV systems, and essentially creating this market in what is a very valuable commodity, and that's the ability to store carbon. We've seen across the board national commitments to making this a key pillar of their policy goals. So if you look at the nationally determined contributions across dozens of countries, there's very large commitments to pushing this market forward. And so we see this as really hitting an S-curve over the next few years, and through the latter parts of the decade and into the 2030s, rapidly building up. And it's millions of hectares of opportunity with a massive impact on the way land is valued. Thank you.
Thank you, Jason. So I'm just going to turn now to our investors. And first, Mary Catherine, can you tell us, just so we've got an overall picture, how are you looking at climate change overall? And then we're going to go a bit deeper into some other areas.
Sure. So I think, first of all, it's just so exciting hearing what Jason and Kate are working on and their perspectives. It felt like last year was a change in investor preferences. This year we have a sort of shift in sort of corporate commitments, as Jason just mentioned. And I think we're optimistic that next year we'll have a sort of a shift in investment behavior and investment decision making. In terms of what we're doing, there's what we're doing for BlackRock as an asset manager, and then there's what we're trying to build to enable others to act on climate risk as an investment risk. So in January of this year, our CEO, Larry Fink, who writes an annual letter to CEOs every year, sort of emphasized that we were going to shift our strategy to sustainability as our standard approach to an investment portfolio, to building a portfolio. And that as part of that, we agreed with the sentiments that have been explicated on this panel already, that climate risk as an investment risk wasn't fully appreciated and wasn't fully priced into markets, both physical and transition. And so we did two things. For ourselves, we're about to file our first Tcfd report in December, in a couple weeks' time, and we did use the inevitable policy response scenarios to inform some of that, as well as other scenarios. But we also decided to build a product called Aladdin Climate. So BlackRock has a financial technology platform called Aladdin. It's an operating system for asset management. It's used by a couple hundred of the world's largest investors. And we saw, as we looked at the landscape of how could we, as investors ourselves, act on climate risk as an investment risk, we did not find solutions that we felt passed a smell test as a fiduciary. There were options that were focused on climate science and sort of maps. There were options that were black boxes and numbers or output without a lot of clarity as to how they got there. There were things that were focused on physical and things that were focused on transition. So while there's been a ton of deep, impressive work done on measuring transition risk, a lot of it is either sector specific or company specific, and not necessarily scalable. And we agreed with what Kate mentioned, and that understanding physical and transition together was critical for an investor. It's worth noting that the time horizons we're talking about in climate risk are very different than what we're used to in financial services scenarios. Your standard regulatory stress test is 3 years, and these scenarios are obviously much longer. So we felt that was just another reason why it's important to give investors more control over the dials of whatever system you're using to look at climate risk. So all this is to say, we felt that it was incumbent on us for ourselves to build a system, and now we hope to drive adoption of that more broadly among a wide range of investors to see the opportunities that Jason mentioned, but also to really be able to, alongside standard, for example, bond analytics, be able to understand what's a climate adjusted price for a given scenario.
It's exciting. And Mary Catherine, if I'm right, I recall that BlackRock's aiming for $1 trillion in sustainable products by the end of the decade.
Yes. So we manage just over $7 trillion total now, total, not sustainable products. We, in 2018, had less than $1 billion in sustainable funds and ETFs, and today we have 86.1 billion. So, I mean, we've seen tremendous growth. So we have a very long way to go from 80 billion to $1 trillion over the next decade. But I mean, if you look at that growth rate, it's not it's certainly possible. So what are we doing to do that? We are building new ETFs that are that have climate risks articulated as part of their strategy. So, for example, we're about to launch an active low carbon ETF. We are launching new active funds. And then we're, of course, starting most of our portfolio construction conversations with this as a lens. So, yeah, we have a long way to go, but so far we're optimistic.
Fantastic, thank you. Bertrand, I'm going to turn to you now. Could you just share with us, as a major asset owner leading in the space on climate, what's your overall approach, and then we'll dig a bit deeper.
Thank you, Sagarika, and hi, everybody. So CDPQ, we manage about 330 billion Canadian dollars. We're a pension fund. We invest on an absolute basis, and most of it internally managed. And that's important to understand what I'm going to put in context, what I'm going to say next. So in 2017, we announced a climate strategy, which was groundbreaking and actually still is, covering the entire fund. And based on 4 pillars. The first one is that we take climate change into consideration in all investment decisions. And I can tell you this morning, I was in the investment committee on 2 deals, maybe spent an hour talking about those 2 deals in aggregate, and probably collectively 20 minutes on climate change. We take that very seriously. Another aspect is that we've committed ourselves to increasing our green investments. They measure about 10% of the fund today, and we intend to do a lot more. We also have committed ourselves to decarbonizing our portfolio while remaining invested in the transition. And so have announced in 2017 a goal to reduce the carbon footprint of our portfolio by 25% by 2025. Those numbers are linked to bonuses as well, or rather the other way around, in quite a significant way. We take this very, very seriously. And we spend a lot of time engaging with companies in the context of shareholder proposals, but also we invest a lot in private assets and therefore have quite a say on the board of these companies and engaging with them and pushing them to take climate change into consideration and take it seriously.
That's great. And Mary Catherine, I want to now turn a little bit to climate risk assessment, transition risk, Tcfd. Can you just go a bit deeper into how you approach climate risk assessment and use of climate scenarios?
It wouldn't be a COVID era panel if someone hadn't been on mute. Thank you. I mentioned that for our own assessment, we use the inevitable policy response scenarios. We have an existing stress testing framework that we've used to stress test our portfolios several times for other regulatory purposes. So in that sense, we're fortunate to have software and basically data mechanisms that make it not that challenging. But as I said before, we see this as pretty hard for many smaller asset managers. And, scenarios are common in this audience, perhaps, and there's a lot of jargon that's very common in this audience, but even trying to get through that to figure out what questions are you trying to answer is a challenge for some investors for whom this is completely new territory, and they know they have to do something, they do not know what. And so we are trying to put in plain English the kinds of questions of how will increased temperatures affect my portfolio, my mortgage-backed security portfolio? How will a carbon tax or other policies affect my energy holdings. I mean, it's very obvious, but I think we're trying to translate these into plain English. And then in terms of scenarios, make available those scenarios that are off the shelf, but frankly, allow investors to create their own scenarios. Because I think if you don't give a portfolio manager the ability to express a view, they may not take action and may not be implemented. Having said that, what we're building with Aladdin Climate is an enterprise solution. So in parallel to having to convince the individual who's making investment decisions, you have institutions making net zero commitments, often frankly without any plan. And so as they develop plans and a pathway, you need a way to enforce that. And so what we're doing with Aladdin Climate is not only supporting security selection informed by certain scenarios, but allowing an organization to set their pathway alignment. And then because our software spans sort of everything that you do to manage money, you can see whether you're tripping a threshold, for example. So an organization can monitor their climate risks. They could prohibit, for example, traders from placing trades in companies that have a certain climate risk or a specific type or a certain level. So I guess to go back to your question, scenarios are critical. Putting them in plain English, we think, is critical. Being able to make them useful at both an individual security selection and then also enterprise level is going to be important to making them meaningful and have the impact that's expected and intended.
Thanks, Mary Catherine. And that sounds fascinating, the enterprise solution and how that would enable monitoring of Paris alignment. Can you just share with us what kind of initial feedback are you getting on that?
Really positive. I mean, I think that what we found is when we show this to pension funds, to asset managers, to insurers, the response we constantly get is, this is exactly what I need. Now I feel like this is a commercial. It wasn't my intention, but you just asked me this question. But that is certainly that's certainly the response that we're getting. And I think it just illustrates that this is such a hard problem to distill into a small decision, not a small decision, but into a series of decisions. And so I think what we find is that clients are thrilled. We also do Tcfd sort of templates, and they also, I think, find that really useful. But generally, we found most of our clients know they need something, and they do not know exactly what that needs to be.
Great, thanks. And Bertrand, I mean, you've got very strong risk background. Could you just go a bit deeper into how you've been thinking about climate risk management, how that's evolved, how you're using climate scenarios? What do they and don't they help you to do?
Yes, we actually took part in a pilot project with the UN a few years back that looked at scenario analysis and came out thinking, with regards to climate risk, physical risk, there is light at the end of the tunnel, and we're taking action on this. I'll say a few words afterwards. With regards to transition risk, the issue is extremely complicated. And as Jason alluded, and this is why we like the IPR so much, is that one needs to discern, one needs to really look at it in a granular basis and not apply a cookie cutter approach. Generally, it gives a sense of scenario analysis gives a sense of directionality. Coming back to physical risk, I mean, we've already undertaken asset-specific deep dive with specific consultants in certain assets. You know, people say, well, I invest in green and therefore there is no climate risk in my portfolio. I beg to differ. When you invest in wind farms, you're dependent on the wind. And whether that wind is going to be blowing too hard or not enough is a very important question beyond the usual wind studies. It's climate change on wind, what happens? The same for hydro. The solar is a little less. So one needs to. So we have done deep dive, and we're in the process actually just now of partnering with a specialist firm to equip ourselves with a tool that will allow us to both assess the physical risk on a physical basis. You know, is it going to be heat? Is it going to be hurricane? Is it going to be flooding? But also put a value on it across our portfolio, from listed equities to infrastructure going through real estate. So that work is in progress, and we take this very seriously. With regards to transition risk, as I mentioned, we need to be very careful and discern and not apply a cookie cutter approach. I'll take a few examples. You know, if if at the end of the road for coal plants, I can tell you there is a cliff. And the question is, get off the car before you go over the cliff. But at the end of the road for oil, well, the road is steep, sloping down the canyon. For gas, maybe it's a pleasant walk down. But for cement and steel, it's going to be bumpy, but I can assure you that in 20 years, we'll be using cement and steel. And in order to build those windmills I talk about, you need cement for the foundations, you need steel for the column, you need plastics for the blades, you need copper for the wiring, and you need ships to transport these things across the planet, all of which are highly carbon intensive. And so the way we look at this thing is we try to find the firms that are the best positioned and invest in helping them decarbonize their activities, which are going to be critical. And this is how we're going to be benefiting and benefiting from those opportunities, both by investing in the green side of things, but also by analyzing the risk, trying to understand it, and investing in the decarbonization of the real economy. And with that aim, we actually joined last year the UN sponsored Net Zero Asset Owner Alliance, and are working with colleagues in that to push this agenda through a lot, which involves both understanding science, but also a lot of engagement with companies.
Thank you, Bertrand. And we're getting some good questions coming through from our audience. So I'm just going to turn now to answer some of those. And if you are in the audience, please do ask questions. And we're going to filter some of those through to our speakers today. So, Kate, I'm going to turn to you first. And I wanted to ask you if you had any initial reflections on everything you've heard so far from Jason, Mary Catherine, Bertrand, and then I've also got a specific question that's coming through our audience, which is around mandatory public disclosure of climate metrics. When will we see this happening?
Great question. In terms of reflections, I've been lucky enough to be paying attention to this space for quite a long time. I led what was known as the Risky Business Project back with Hank Paulson, Mike Bloomberg, and Tom Steyer back before my current position, and actually in that project created the underlying data set as an open source data set that BlackRock is now using for its asset, which is owned by Rhodium Group, and asset is now and BlackRock is now using. So I'm very happy to have been part of this from an early day on the physical risk side. So really thrilled to see on the BlackRock side just the progress that's been made and the translation into real action, and couldn't agree more on translation into real, kind of language that people understand. I think that's incredibly important. I will reflect very quickly on what Bertrand just said, which is that I really appreciate the recognition of the continued need for industrial development. This is something I think sometimes people in the climate community kind of conveniently forget about. It's the inconvenient truth of the climate world we're looking at, which is that you can't build a carbon neutral economy without still doing a lot of industry. And we're very focused in California on hard to decarbonize industries as well, and particularly in innovation in carbon removal and CCS in those industries. So that's just something I wanted to put on the table. We have the world's actually most valuable credit for that right now through our low carbon fuel standard. We actually provide a credit for CCS on industrial fuel production, and it's very valuable and used a lot. So I really wanted to underscore that as well. So thanks for those comments. When will we see disclosure? Disclosure is hard. I think everybody's been saying this. I think one of the huge opportunities for us as a state who's seen as a leader on climate is that if we put something out, a lot of people will pay attention to it. That's also a big challenge, because if we put something out, a lot of people will pay attention to it. And I don't know that there's one answer to how people should think about disclosure. I do think that we just increasingly feel that we can't continue putting public dollars into projects and into companies that are not thinking about these things, that we can't subsidize risk with public dollars. I think that's where the Biden administration is going as well. that's easiest and the lowest hanging fruit. And what we're thinking about first is through our own procurement and contracting systems, because that's a direct transition of public dollars into private activity. And that's where we're likely going to start and expect other governments to start as well. We're also keeping, of course, an eye on the federal conversations around public companies. I think that really does have to happen at a federal level because it needs to be consistent across all states and ultimately globally. So this is why we joined the Coalition of Climate Resilient Investors. Our pension funds are members of the Net Zero Asset Owners Alliance because we really are trying to do this in coordination with others around the world so that we don't end up creating a system that adds just frankly like another disclosure requirement on top of the 15 other valid voluntary disclosure requirements people already have to deal with.
Great, thank you, Kate. And I've got another question coming in that I'm going to ask Bertrand and Mary Catherine as our investor speakers. And the question is a very blunt one from our audience. It's, how do you avoid greenwashing as everybody is keen on doing good now? Bertrand, maybe if I could ask you first.
Yeah, I could barely understand your question, but you said, how do we avoid greenwashing?
That's right.
Yes, by being transparent. When I said we have 10% of our fund invested in green assets, we use a benchmark for that, which is an external benchmark, which is a European benchmark, and classify our assets along that. And that is public information. We also have our carbon footprint audited, and our assets are listed on our website. We also disclose the type of the positions that we take in shareholder assemblies in public companies. And so people may not always agree with what we do. People have different views, but we are completely transparent about it. And try to explain what we do and why we do it.
Great.
And I would
agree. Mary Catherine?
Yeah, I would just echo that. I think the transparency is the critical part. As long as you're clear about, well, what's in a fund, how and why, how are you defining ESG or sustainable, for example, those are the important things. But SFDR in Europe does obviously have some requirements that are going to reduce greenwashing. Frankly, they're really hard to comply with because a lot of the information needed to demonstrate that you're not engaging in greenwashing doesn't necessarily exist or isn't actively collected. But I think that it's a valid concern because there's no question it's happening, and there's no question that it will continue to happen. But it's hard to prevent. I think one thing I'll just say is in the case of investment products, most sustainable ETFs or index products are it's fully disclosed and transparent how you arrive at that index. And so I think rather than being concerned now about the composition of those, what we're trying to do is just build new ones that would meet a higher standard of what constitutes a low carbon investment strategy. So
I just want to say 2 words on this, just because I think it's relevant to what Jason was talking about and what I was talking about in terms of the land strategy. Just being careful about what we say is greenwashing. One of the things that's very challenging on the land side is that literally one of the only current opportunities to value the kinds of projects we're talking about to increase carbon sequestration, for instance, on lands, are offsets, right? And offsets get a bad rap because people say, oh, is it additional? Is it verifiable? All really important questions. But offsets do play one of the only roles right now until things change in helping us value those land strategies. So I do think it's important to sort of say, what are the ultimate goals we're trying to get to? What are the different priorities we can put on them, and not hang our hats too much on the perfection of the solution, because sometimes we need interim solutions to get there.
Great, thank you. And I've got another question coming in that I'm going to direct to Jason, which is around China. So far we've had a lot of focus on the US and this session, and we just released today the Inevitable Policy Response, looking at the Biden plan. But could you just tell us a bit more about your perspective on China? They made a net zero by 2060 commitment, but still we know there is a lot of coal in China. What's your sense about how this is likely to play out and some of the key areas you see China moving in?
Yeah, I mean, so I think that's an excellent question, and China is today the most important country, I think, in terms of assuring kind of the inevitable policy response trajectory that we've been pointing to. It's both its domestic policy, but also its international policy, particularly through its investments overseas and through what's often referred to as the Belt and Roads Initiative. I think China is undergoing quite a fundamental transformation, and it has to do with the shift in its industrial base and the shift in what it sees as its economic opportunities. Not to say that Chinese policymakers don't also have the good of the world in mind. I mean, I do think there are many enlightened voices in China, and I don't want to underplay that as an important factor. But I think in terms of the kinds of barriers to change and why those barriers are shifting, I think a lot of it comes down to this fundamental shift. And China has, as we know, traditionally relied on relatively more carbon intensive industries. That's been its pathway to growth for many years, including, of course, powering that with coal. But China made significant investments in innovation. It's now the leading producer of renewable energy. It's got the largest electric vehicle production capacity in the world, and it understands that I think its future is around facilitating that. Its industrial strength, its economic strength is going to rely on those new industries, and those new industries have a lot of advantages compared to the old industries. So this will take time. There are interest groups on both sides, but I think we've seen a significant step in that direction in terms of long-term vision with the 2060 announcement, and we're going to see this play out kind of year by year, a steady shift towards a kind of a newer and lower carbon economy.
Thank you. And I'm going to finish by asking each of our speakers a little bit about what they'd like to see a year from now when governments that are in the Paris Agreement, and we hope the US will be one of those, are thinking about their action, what exactly they do at COP26. What would you like to see from governments at COP26 in November 2021? And while you're thinking of that, Jason, I'm going to ask you one quick follow-up, which was, at the start, Kate was speaking a bit about just transition, the social issues. Obviously, in a COVID recovery phase, which we all hope we'll get to as fast as we can from this relief phase, green jobs is going to be a very important theme and potentially a driver of government action. To what extent in some of the opportunity areas you've described do you see green jobs as a potential area for growth?
Yeah, I mean, so the evidence on this is fairly clear that kind of newer and some of the emerging cleaner technology areas offer a large job creation potential. They're widespread, covering kind of all sectors, all states and regions, and also a broad set of skill sets. And so I think they have a very large role to play in terms of the recovery. A shift in investments towards these technologies that will help drive growth quite significantly. And I'd say that in some ways, though that as a driving factor will be pretty important in the political shift over the next 4 years. I mean, taking the United States as an example, I mean, we saw the results of the election in regions that are concerned about job loss. And I think a Biden administration and similar to what we've seen in Europe and other countries will be looking to show and demonstrate how stimulus in these new sectors can create jobs and can potentially change the political dynamic. So I think it's critical, and I think the cards are stacked relatively in favor of green as a key part of stimulus on that front.
Thank you, Jason. Well, I'm going to turn first to you, Bertrand. What would you like to see from Paris Agreement COP26 in 2021?
I would say that the world's already well engaged towards green energy. The framework is there, and the costs are low enough that it's happening. There are now policy moves towards reducing internal combustion engines, which will have an impact on oil. So all that is done. I think one thing that is, done, it's underway, far from done, but underway. One thing that is missing is policy action towards industrial carbon capture, because there are so many activities that cannot be decarbonized quickly or not at all today, such as flying. But it's important. We would be keen to invest in solutions, but the policy framework is not there yet.
Thank you. Mary Catherine?
I will leave the policy recommendations to the others, but I think that one outcome that would have a huge impact in companies' investors' ability to contribute is, and this is everybody's favorite sort of refrain, is some standardization on climate disclosure.
Thank you. Thanks very much. Kate?
Yeah, thank you for the question. I mean, I think we need to recognize, see at COP a recognition that climate change is an economy-wide issue. It is like globalization. It is like automation. It affects everything and everyone. It's not a niche set of issues that's in the environmental space anymore. So 2 ways to really highlight that. One is I just don't think there are any green jobs. There's only greening the entire economy. There's no longer a subset of jobs that are these jobs. We need to talk about the full economic transformation. And there's enormous potential in that because it's a reframing and a rethinking of investment and redirection. The other piece is that we need to really see the finance ministers and the economic folks step up at COP and be part of the conversation in a real way. We're starting to see that. There's a finance minister group that now meets, but I think that is just critical to putting this on the table as an economy-wide issue.
Great. And finally, Jason.
Yeah, so I mean, I'm going to take my I think what my favorite niche. I think that we're really in need of action that will start to enable the valuation of these climate benefits. I mean, I think it goes across what Bertrand was saying in terms of enabling things like CCS. I think it's going to be critical for the land use sector, and I think when we're looking at the next horizon of needs to really fully decarbonize the economy, moving beyond renewable energy and vehicles, it's going to be about making sure that those new technologies that help us get to negative emissions technologies, that those new markets are robust and standardized and able to be financialized at scale.
Great, thank you very much. And from my perspective, what we would like to see at PRI is much more ambition from governments in terms of moving towards net zero as fast as possible, and also to see that happening increasingly in the finance sector. So I hope you've enjoyed this session. If you're in the audience, we've touched on a range of areas. We've done a little deep dive into California. We've looked at the US and Biden, some of the key areas we think where there could be action. We've taken an investor perspective, thought about the opportunities and also climate risk assessment and how scenarios can help. You'll find all of the resources that we've described available in the platform. The recording will be available, and the inevitable policy response work is all available on the PRI website. I'd very much like to thank our speakers, Kate, Mary Catherine, Bertrand and Jason. Thank you very much for your time today. And with that, I'm going to pass back over to Lindsay. Thank you.